Good afternoon, everyone. Chris Brecher here with TradingNest.tv. I was going to do this learning video just for our premium members. I decided it's such an important one. It's a basic concept of how we trade day in and day out on Trading Nest. So I thought I'd go over it. Number one, zero DTE. There's a time and a place to play them. If it's a choppy market and you're buying premium, you're going to get hurt. But there is a time and a place. So I thought I'd go through step by step how you could have played it today and made 500%. Not every day, and it's no guarantee, but why it was more likely you would initiate the trade. So the first thing is identifying the direction. Now, I just can't stress enough that we are into extremely simple concepts. I've been doing it 44 years, and the more simple a concept, the more that it's followed. You don't have to pay for indicators. You don't have to pay for any kind of chart or support or resistance. These are extremely basic and they work day in and day out for free. Number one, identify the trend. Right now, the trend is down. Doesn't mean every day down, but it means sell rallies at resistance. The other, take basic concept. Prior bottoms become resistance. Do you see the resistance? When you see that, you look for the short-term chart to time your entry. So this has nothing to do with trampolines or Fibonacci's or Elliott Wave. This is really basic. That's all you need. The more basic, the more it's followed. Prior resistance, prior bottoms become resistance. Next thing to do, identify the short-term trade. So the first thing you want to know is trend lines, which I've had on a lot of learning videos, and your risk reward. So let's go over that. First thing you're going to want to do is go to a 1 minute chart of the S&P. I'm not going to show you anything in here at all. I'm going to show you that pattern. I hope everybody can see this a mile away. You had a prior sell-off that projected about 4.85. A bear flag doesn't have to be like you see on the internet, straight down and that. It's a sell-off and then a tight consolidation, which brings me to the next thing. The more points of contact, I have a learning video, the more important. So you had a prior move down, as you see, a prior move down, and then look how many times the point of contact. The more points of contact, the more important. So in here, you could short it with a tight stop. So basically, you're risking about a half a point if you're wrong. How do you know you're wrong? If you short it right here and it gets above there, that's how you know you're wrong. But if you're right, you're going to make 4 points. Look what actually happened, the projected move. That's 4.85 if it's a just a by definition of a bear flag. 4.64, that's pretty close. Pretty darn close. So the point in there is you might not want to trade the SPY. But if you do, if you want to experiment, you go and short 10 shares in here and you stop yourself here. But here's another way. When you see that big a bear flag in a downtrend, there's another way to trade it. This you're more likely to do. Zero DTE. So let's go to it so you know what we're talking about. So now what I'm going to show you first is just a big old chart of what I just showed you on TradingView, but show it on Thinkorswim. You see the defined trend line. Look at all those points of contact, and so on. You see the points of contact. So if you short it right here, you have a tight stop. You can also, this corresponded with that ATR trailing stop I like using. Yep, I'm combining a lot of my other learning videos. But the key in here is the objective is a lot this time. So this is a good way, a cool way to trade it. So you're talking about a 4-point expected move. You don't have to buy deep in the money puts. When you're expecting that kind of move and you're in an overall downtrend, a lot of times these work. So let me just show you really exciting. We're going to restore the cells. And then I'm going to take it over here. You saw it over here on the right. So if you're wrong, it's going to go up that amount. Guess what? The 650 puts, they were sure they were out of the money by 7 points. More, 8 points. That's not the point. The point is if it breaks, you made 500%. you never had a chance to lose. But number two, if you did lose, if it did reclaim this on the right up here, what were you going to lose? 5 cents? 3 cents? Now remember, I'm not talking about doing this as a long-term idea. And I'll show you what we're talking about. You can see it right here. On the right, the S&P went down after the opening, and the puts went down because it went down slowly. Just keep that in mind. Well, in here was actually the bear flag, but over here, there. So you went down, but it's still lower than where it closed. But I'm just telling you, when you play these, you want to play them on the defined trend line. Now, you can play them on the opening, but you're just not going to have the same bang for the buck. So if you bought them right here, when it started going down, right here. So you bought them at 37 cents, you might have made 50 cents right in here, even though it sold off, because it just didn't go down that fast. But this one, yeah, that was a great bang for the buck. So you're buying down here at 13 cents on the bottom left, with probably your risk is 5 cents. But if you're right, it's going down fast. And as you see, you never would have even had time to sell them for a double. You would have made 500%. So the key, now you might say, well, how do you know it wasn't going to crash? You were going for the objective. Now, let me just tell you, if you didn't want to go like that, you do twosies. You do money management. So you buy two. You buy two down here. When it started spiking, you sell half. So you're laying out, let's say 15 cents. Let's be realistic. So you're laying out $30. You're selling one at $60. So now you have a double whether you sell the next one or not. Let's say you're like, I know the market's going to crash. Well, remember, the 650 puts here are still 4 points out of the money, and now it hits support. It's not going to go down as fast. The key is on that gap, the path of least support is down to this gap zone. That zone. I don't call it the exact gap. So there are two areas. There would be there and there. The problem is right there, it never stopped. So you never would have been out. So you would have sold half here. Once it started going up, you probably sold at 70 cents here, and the next one at 40 cents. So you sold it for $110 worth when you outlaid only 30. I'll take that any day. So I hope this video helps. That's how you trade the 0DTE, in my opinion, which means not always. One, you're in an overall long-term downtrend. Number two, you rallied to resistance on an hourly. You're in an overall long-term downtrend on a daily, and it sold off with a consolidation formation with an objective that was huge. So you had a lot of reasons to buy cheap puts. So take care. Like I said, TradingNest.tv. I do learning videos like this all the time. We do these types of trades all the time. We like doing long-term trades, short-term trades. We do them all. Take care. Have a great day.